Good morning, or afternoon, or evening, and welcome to this recording of Ready to Retire. My name is Thomason Propson, and I'll be the voice to these slides shared today. I'm one of several benefit specialists who works within the Central Office of Human Resources here at UW-Madison, and we look forward to sharing information via this Ready to Retire session. I personally have been presenting on this topic for going on 13 years, and I feel confident that the topics discussed today are valuable to all who want to learn more about the Wisconsin retirement system, pension, and retiring from the UW-Madison. Our goals for today's recording are three-part. By the end of our time together, we hope you'll feel confident in the basic steps to take as you approach your retirement date, and the information shared with you today should help you choose what is likely to be your quote-unquote best date for retirement, if that's what you're seeking. And though you'll no doubt still have questions following this session, you will have names, numbers, and links of resources that will help you move forward with your plans. A quick note, we in UW-Madison Benefit Services are not tax advisors, nor are we financial consultants. So please direct questions about your personal finances and taxes to your financial and tax advisors. That said, we are happy to help you if we can. So please do email us your benefits at retirement and retirement process questions. Send to benefits@ohr.wisc.edu. And if we can provide answers, we will, or we'll do our best to direct you to resources that can support you. Listed on this slide is an overview of the topics to come. We have an introduction, information about health insurance and the sick leave program, information about choosing when to retire and how to announce and share your retirement, a quick overview of the Wisconsin retirement system and the pension options available, and some post-retirement information, and a closing that makes suggestions on what you may want to do next after you've finished watching this video. First up is our introduction to retirement from the UW-Madison. You can begin your Wisconsin retirement system retirement benefits when you are vested in the Wisconsin retirement system, and that usually means that you have at least 5 years of creditable service. And if you are at least age 55, or you could even be as young as 50 years old if you're a police officer at the UW, and if you end your Wisconsin retirement system employment. There are many resources that are published or otherwise available about the Wisconsin retirement system and retiring from UW-Madison. 3 primary resources are listed here. We have ETF's video about the pension, aka annuity design options, the Universities of Wisconsin's sick leave conversion program estimator, which we'll talk more about today, and ETF's online retirement checklist. If you haven't already reviewed these pieces of information, I encourage you to do so after this presentation. Other resources include our UW-Madison Roadmap to Retirement checklist. If you'd like a copy, just email us, we'll send it to you. And ETF's Guide to Retirement pamphlet. 2 other resources you may find valuable as you consider your annuity design options are ETF's Calculating Your Retirement Benefits and their Choosing an Annuity Option pamphlets. Very useful. Now, I've said their name a few times already, so let me officially introduce the most important connection you can have to your future Wisconsin retirement system, or WRS, pension and retiree health insurance plans. It's the Wisconsin Department of Employee Trust Funds, whom we call ETF for short. And it is ETF who administers the WRS. They offer numerous pamphlets, webinars, and calculators to help you explore your future retirement benefits. And it will be they who, in a way, become your quote-unquote employer when you retire, because it's they who pay to you your monthly annuity, and it is they who administer for you your retiree health insurance. So ETF is an extremely important contact point for retirement and planning, but many others are also involved. The Universities of Wisconsin and UW-Madison specifically have resources offered to you for example, this presentation. Our Benefit Services Office at UW, which is where I work, can meet with you in a one-on-one benefits at retirement appointment, if that's something you need as you approach your end of employment. The Social Security Administration will be your contact for Medicare and Social Security benefits, and it will be your own department or division HR who will accept your resignation letter and update the payroll systems with your impending end of employment date. And then very key to the process is, of course, you, yourself. You are reviewing information that's available, you're asking questions, and it is you who usually decides when it is you will retire and when to make your announcements to others. There are a few other contacts to whom you might decide to reach out to if you'd like to talk about how you're feeling about planning for retirement. It is such a big life change, and it can hit us all in different ways. So if you'd like to talk to a UW-Madison counselor about how you're handling the plans, you can contact UW-Madison's Employee Assistance Office. And there is also their contract with Life Matters, who has their own counselors who are not UW-Madison employees, but they are also available to all of us to reach out to and to talk about big life transitions. And another resource is the UW-Madison's Ombuds Office. This office is staffed by former UW employees who have themselves retired. And so they've been where you've been. They can provide their own informal thoughts about how to best prepare for retirement, things to consider or expect, for example. Next, let's talk about an important change in retirement, the switch to retiree health insurance. And using your sick leave, if you've been able to save sick leave as an employee, to bring with you into retirement that can initially pay for the retiree health insurance premiums. First, it's worth mentioning that if you are an active employee and you're turning age 65, there is no change to what you pay for your health premium costs as an employee, and you aren't yet required by our plan to enroll in Medicare unless you're already drawing Social Security benefits. In that case, Medicare or Social Security does require you to enroll in at least Medicare Part A. But in general, if you're part of our health insurance plan as a large employer, you're not required to enroll in Medicare immediately when you turn age 65. If you're curious about Medicare, Medicare Part A is usually free, but Medicare Part B, which I have on the screen here, does cost money each month to be a part of. So on the screen, I have the current 2025 prices, which are based on income back in 2023. If you're watching this after 2025, I recommend Googling Medicare Part B premium cost to find the updated numbers. When you retire, if you have the state's retiree health insurance, it's at that time that you must enroll in both Medicare Parts A and B if you are age 65 or over. The same would be true for your spouse if they are also on your family retiree health insurance. So in retirement, your Medicare A and B will take first crack at your medical bills, and what they don't cover 100% will filter down to your secondary health coverage, the state's retiree health. The state's retiree plan has its own built-in Part D policy for your prescriptions, so you do not need to purchase a separate Part D policy elsewhere. And to pay for the state's retiree health plan, your sick leave value, if we are able to certify your sick leave following your retirement, will pay the state health premiums until the sick leave value is exhausted. More on that coming up. I also want to point out that if you have health insurance through another employer, through your own other employer or through your spouse's employer, you should ask that plan's administrators about their requirements for Medicare if you or your spouse are turning 65, because they may or may not require that you sign up for Parts A and B. They may have different rules than our own state health policy. So in today's session, when I talk about health insurance after retirement, I'm speaking about the state of Wisconsin retiree plan and also perhaps how it might coordinate with Medicare if you or your spouse are 65 or over. You might have other options for health insurance in retirement. You might have your spouse or partner's insurance. You might have a new employer who's offering you health insurance. You might have purchased your own individual policy somewhere. Or if you're under age 65, you might be considering the marketplace coverage. So you might have other options, but today's presentation, we're focusing on the state of Wisconsin retiree plan, and again, parts of Medicare that will interact with it. So in retirement, you will owe the full monthly premium for your retiree state health coverage. And in 2025, most of our Dane County area plans, their full cost is about $1,000 a month if you're on a single plan, or closer to $2,400, $2,500 a month if you have a family plan. Now, those premiums would be lower if you or your spouse are 65 or over and have enrolled in Medicare Parts A and B, and I'll have those prices coming up soon. But again, generally speaking, $1,000 a month, if not $2,400 or $2,500 a month, is what our local plans truly cost, their full premiums. And this is where your sick leave can be so valuable in retirement if you've been able to save it throughout your career, and we can certify it for you going into retirement, because your sick leave can pay for that monthly retiree state health premium. If you're under the age of 65 and you're on the retiree state health plan, then your certified sick leave credit account goes towards paying that retiree state health premium, and that would include your preventive uniform dental if you've been attaching that to your health election. If you are or your spouse is age 65 or over and you're on the retiree state health plan, then, as mentioned before, the program requires you or your spouse to enroll in the federal Medicare. You have to elect Medicare Part A, which is usually free to you, but you'll be enrolling also in Part B, which will have a cost to you that you will pay to the federal government each month. And then as your secondary coverage to kind of fill in the gaps for things that Parts A and Part B didn't cover in full, then you'll have the state's retiree health plan, and its premium will be covered. If you have sick leave credit, your sick leave credits will pay for that retiree state health coverage, and that will include your Medicare Part D for prescription coverage, and still the preventive uniform dental plan if you've attached that to your state health insurance. And so I've just included in this session a few slides that give you more information about Medicare so that you have places to start if you have questions about signing up for Medicare. So here is just a note about how you do not necessarily need to enroll in Medicare when you first turn 65 if you have health insurance from your job that is from a large employer. So you could look more about that on Medicare.gov if you'd like to. I've also included this chart from Medicare.gov that addresses the question about what if my health plan or employment ends within 8 months of turning 65. There could be different rules about when your Medicare coverage could start. And then finally, very important, that employee trust funds requires you to have that Medicare Parts A and B if you're part of their retiree health plan and you or your spouse are age 65 or over. So you must sign up for the federal Medicare Parts A and B to coordinate with the start of your state group health insurance as a retiree. On this slide, as I mentioned previously, we have the full monthly premiums in 2025 for what retirees would pay for their continuing coverage with the state if they are not eligible for Medicare. Neither the retiree nor their spouse are eligible for Medicare. Again, you see it's about $1,000 a month if it's just you on the policy alone, or it's nearer to $2,400, $2,500 a month if you have the family plan. It could be even more expensive if you are enrolled in the Access plan, which you see at the very bottom of the slide here. The Access plan is more expensive because it has nationwide coverage and it's a PPO that allows you to see any doctors anywhere. And for that expanded network and coverage available, they do charge more for their plan. So it's $1,700 a month if it's just you on the plan, or it's just over $4,000 a month if you have the family coverage. The prices could be slightly different if you're on the high deductible health plans, but again, they're still in the same ballpark. And then on this slide, we see the current 2025 monthly premiums for retirees who do have Medicare. This is for those where the employee or the annuitant, the retiree themselves, has Medicare, as does their spouse. So if your entire covered members have Medicare, then the premiums are reduced. And in this case, we see in the Dane County area, the Dean, the GHC Dane Choice, and the Court CW Health options, they're closer to $600 a month for a single policy, or it's about $1,200 a month if it's the family coverage instead. Or those top two rows, we have the Medicare Advantage option through United Healthcare, or the Medicare Plus option, also through United Healthcare, which offer their own nationwide options. So you would have some different option networks to choose from if you are retired and you have Medicare. There are more details about what these retiree plans look like, how they function, and you can find the details in Employee Trust Fund's decision guide. There's a new decision guide published every year. I link here to the 2025 version, but there'll be a new one for 2026 and every year thereafter. And so you'll see information about what the retiree plans look like if everyone who's covered is under age 65, or you'll see the details if everyone is over age 65. And then there are also details about coverage if only some of your family has Medicare, but others do not. That's what they call their Medicare Sum plans, and they have their own monthly premium cost. So you can compare the state's plans, whether you have the Medicare Advantage plan or the Medicare Plus plans, or one of the more Wisconsin-based health plans. And then you'll also see in this decision guide what the supplemental plans might be as optional for you. There's the supplemental dental plans, there's the vision insurance, and so you can look in more detail for those options in the decision guide. One important piece to discuss is just noting when your employee state health insurance ends and when your retiree health insurance could then begin. Your employment date affects both the end of your employee health insurance and then the start of your retiree health insurance. So what I would recommend if you are announcing your retirement when it comes time to your department through your resignation letter, be very clear about what your last day will be as an employee. So the example on the screen shows someone who is telling their department that they are retiring January 1st. And usually you're retired the day after your last date of employment. So if you're saying you're retiring January 1st, it wouldn't be incorrect necessarily for your department to have entered an end of employment date of December 31st. That was the last day you were our employee, and now you're retired January 1st. But if that is what is entered, then your employee health insurance ends December 31st, and thus it's January 1st when your retiree health insurance could begin. And if you were eligible for Medicare, that's also January 1st when you'd have to arrange for Medicare Parts A and B to begin. If, however, your intention was to say that you are retiring and your last day will be January 1st, then the health insurance start and end, or end and start dates are different. So if your last day is January 1st, then you could be retired as of January 2nd. But because you were our employee on January 1st, even though it's a holiday, then your employee health insurance would continue through the end of that month. It wouldn't end until end of day, January 31st. And thus it would be February 1st when your retiree health insurance could begin. And that's an entire month difference of when, if you needed Medicare, when your Medicare Parts A and B would need to be in place. So when you come to announce your retirement to your department, be sure that you let them know that you are retiring, but then share what your last day as an employee will be. That's what they need to enter into our system to make sure that everything flows correctly as you had wished for your health insurance. And then as you're moving to the retiree health insurance, your sick leave will come to be an important factor if you've been able to save sick leave as an employee and you're enrolled in the state's health insurance at the time your employment ends and you're starting your immediate WRS pension annuity, then my office can certify the value of your sick leave and send that value to employee trust funds who will use it to pay for your monthly retiree state health premiums for as long as your sick leave value holds out. There are two possible parts to your sick leave certification. There is the Accumulated Sick Leave Conversion Credit Program, the basic program, which its initials are ASLCC. And this is where we look at the number of sick leave hours that you yourself have earned and saved, and we look at your highest hourly base wage, and we certify then the value of your sick leave, the number of sick leave hours you have times the highest hourly base wage, and that becomes the value of your certified sick leave account that ETF uses. But there could also be a second part to sick leave conversion for you, and this is called the Supplemental Health Insurance Conversion Credit Program, also called SHIC. And SHIC is available if you have at least 15 years of continuous state service. This is continuous service where you are earning state sick leave all that while. If you have at least 15 years of continuous state service, then to your own sick leave that you have been earning and saving, we could add some extra sick leave according to a formula that we're allowed to add extra sick leave, and thus then both of those accounts would be going into your final certified sick leave account, and then ETF would use that account to pay for your state health premiums. So if you have more than 15 years of continuous state service, excluding those who are in the trades or in the crafts, unless they're supervisors, that could just add to the value of your sick leave account to be used in retirement. And so your sick leave, if it's certified, whether or not you have the extra SHIC, even if it's just your own sick leave because you have fewer than 15 years, will be available for ETF to use to pay for your continuing state group health insurance. And your sick leave will then be used either immediately at retirement. You just allow ETF to continue your enrollment onto the retiree health plan, or you could officially escrow your sick leave by showing ETF that you have other comparable health insurance that will start. Maybe you are moving to a new employer, you're going to move to your spouse's insurance, and you can prove to ETF that other coverage is comparable to the retiree health plan, and thus they will escrow or preserve the value of your sick leave until that other coverage ends and you can return to the state's health insurance plan and wake up those sick leave hours that had been frozen for you. However, if you don't do either one of those, if you don't immediately begin to use the sick leave, nor do you officially escrow it, then you forfeit your sick leave value. So you can use it, you can escrow it, or you can lose it. And I would prefer that nobody lose the value of their sick leave if possible. So again, consider immediately continuing your coverage onto the retiree health plan or officially escrowing its value. And the value of your sick leave credit account can be used just for essentially paying for the state retiree health premiums. The other way they can be used is to be escrowed by ETF, but then later the only value to them is if you wake them up and then use them to pay for your state retiree health premiums. That is the value of sick leave in retirement. Sick leave credits cannot be used to pay for other health insurance that's not directly offered by the state's retiree health plans. Your sick leave credit value can't be cashed out. It doesn't earn interest. It cannot be used to pay for supplemental plans like the retiree vision or major dental coverage. It can't be split between different people. You can't gift your value of sick leave to someone else other than allowing your family members to use it if you pass away while they were covered by your retiree health plan. And that's coming up here on the next slide. If you have family state group health insurance and you pass away, the value of your sick leave account will be offered to your surviving family members so that they can continue to use that sick leave value to pay for the family's health insurance. That's true for active employees as well as retirees that would be offered to the surviving family. However, if you die with just single state group health coverage for yourself, then your sick leave passes away with you. Your surviving family will not be offered the value of the sick leave because they weren't on your state group health insurance at the time of your death. Now, if you are married to another state employee and you still have family state group health together, one of you has chosen to enroll the family under their own name for the health insurance, and then one of you passes away, the deceased's sick leave will be available to the surviving spouse for use towards paying for retiree health insurance premiums. They'll have their own and the deceased sick leave to use. However, if you each, as state employees, have your own separate single state group health plans, and then one of you passes away, the deceased sick leave passes with them, and the surviving spouse just has their own sick leave to use to pay for retiree health insurance. This is often why, even though two separate single health plans are often less expensive than one family health plan, nevertheless, two state employees often will be on a family plan combined in order to allow sick leave to move between the two of them if one dies before the other. You can estimate the value of your own sick leave by visiting the Universities of Wisconsin website, where they have an estimator tool that allows you to plug in kind of what you expect for your future retirement health insurance, what type of coverage you have, the network that you'll be part of, will you have the preventive uniform dental attached or not, and you can also imagine how much more expensive health premiums may become from this year to that future year when you'll retire, and some other details about yourself and your current balance of sick leave, for example. And then this program will do the work to imagine how much value your sick leave will have to you in the future, not just dollar value, but how much purchasing power it will have to pay for future retiree health insurance. One of the questions that estimator will ask of you is, what is your continuous state service date? Or what is your adjusted continuous state service date? And they're asking this because not all Wisconsin retirement system eligible employment is considered continuous. So continuous state service is service when you are working for a state employer and you've been earning sick leave, and there really haven't been any large breaks in sick leave earning employment. So continuous service can be adjusted if there are short breaks in eligible employment, but if there are longer breaks, then that resets and restarts the continuous service date. I have a visual here to try to provide an example of what these different types of continuous state service can look like with or without breaks. So the first row at the top here is someone who was hired. They worked for 30 years, all the while with the state earning sick leave, and now they're retiring. And their years of continuous state service happen to match up with their employment dates. So they have 30 years of continuous state service. The second row has someone who was hired and they worked for 15 years earning sick leave, but then there was a short break during which they were either working for a private employer somewhere, or maybe they were with a local Wisconsin retirement system employer, earning local sick leave, but not state sick leave. Or maybe they were still a state employee, but they were in an LTE appointment that doesn't earn sick leave at all. So for a short window of time, they were not earning state sick leave, but then they were rehired into a new state sick leave earning appointment. They worked for another 13 years, and now they're retiring. Their adjusted continuous service date will be kind of the count of those first 15 years and then the latter 13 years. It will ignore that short middle piece that was just a very brief break in sick leave earning employment. And then the third row shows someone with numerous short breaks of employment. They worked for 7 years, there was a short break where they were earning state sick leave. There was another 7 years when there was a short break, not earning state sick leave, and then they worked for 12 years and now they're retiring. And so we would kind of scooch the first 7 years up against the second, and then that one up against the 12 years, and we've created, in a way, a pretend hire date. It's their adjusted continuous service date. And in these two middle examples, as well as the top one, these examples have had more than 15 years of continuous state service, and so they could be eligible for the extra sick leave when they retire. They would have potentially the SHIC, extra sick leave, added to their sick leave account. Now, the lowest row is someone who had been earning state sick leave for 15 years, but then there was a large break of sick leave earning state employment. It was maybe 6 years or longer, it was a significant break. And then they were rehired with the state and they've been earning sick leave for the more recent 9 years, and now they're retiring. In that lowest example, though the first 15 years and the latter 9 years may have been Wisconsin retirement system employment, they may have been earning service that will help their annuity, their pension. It's only the latter 9 years that we can look at as far as continuous state service to see whether they're eligible for the extra sick leave that can be certified for them. And in this case, they only have 9 years of continuous state service because we have to ignore the earlier 15 because of the large break. And so going into retirement with just 9 years of continuous service, they will not be eligible for the extra sick leave, but they could still have certified for them the sick leave that they'd earned and saved themselves in that 9 years. They just wouldn't be eligible for the SHIC. Here's an example of kind of how we parse out what the value of someone's sick leave credit may be as we're counseling them, for example. So in this example, we have someone who is retiring after 26 years of continuous state service. So they've been earning sick leave by some measure or another for 26 years. And this individual's highest base rate of pay was $50,000. And we break that down into a value. In this example, the value is $23.95. So each of their 1,920 hours of sick leave that they themselves are taking with them into retirement is worth $23.95. And then to their own sick leave, we can give them SHIC, the extra supplemental sick leave credits. So for the first 24 years of their continuous employment, we can give them 52 hours of sick leave for each of those years, so another 1,248 hours. And then for their 25th year and their 26th year, we can give them another 104 hours for both of those years. So that's another 208 hours. So they are bringing 1,920 hours with them into retirement. We can give them another 1,456 hours of sick leave, and those 3,376 hours of sick leave, each worth $23.95, creates a sick leave account credit of $80,842. And it's that $80,000 that ETF receives and will use as a credit to pay for their retiree health premiums. In this second example, we've changed the details slightly to show someone who, though they did have 26 years of continuous service and each of their sick leave hours will be worth $23.95, they weren't able to save as much sick leave as in that earlier example. They had had reasons to spend sick leave during their employment, and so they are retiring now with just 1,000 hours of sick leave. So they're taking that 1,000 hours with them, and to that, because they do have more than 15 years of continuous service, we can provide them extra SHIC, supplemental sick leave credits. But the rules about the supplemental credits is that you cannot give someone more in supplemental credits than they themselves are taking with them into retirement. So if this individual theoretically could be receiving 1,400 and some hours of sick leave through the SHIC, we can't give them all of that because they only have 1,000 hours themselves. We can give them up to another 1,000 hours. So a total of 2,000 hours is being certified for them for use in retirement. And thus their sick leave credit is lower than in the first example. There are some other rules you should know about being eligible for sick leave conversion in retirement. The first is that you must have state group health insurance at the time your employment ends in order for my office to be allowed to certify your sick leave. So if you are, eligible for retirement, but you do not have state group health insurance as of your last day of employment, then we are not allowed to certify the value of your sick leave. Unless, there is an exception, unless if you are too young to retire and you have at least 20 years of WRS creditable service, then we still could. But if you are already of retirement age and you don't have the state group health at the time your employment ends, we will not be allowed to certify your sick leave. What that means is that if you are an employee who currently doesn't have state group health insurance and you do expect to be retiring soon, know that you must be covered by state group health at the time your employment ends, and you must begin your immediate annuity if you want your sick leave certified. So you can either enroll for state group health insurance during the fall annual open enrollment so that your coverage will begin January 1st and then you retire after that. So you retire January 2nd or later in the year so that you did have the coverage when your employment ended. Or if you're going to be retiring before next year, you can enroll in a special way mid-year by submitting to us at the UW a health insurance application. You can apply for the Access Plan, and it's nationwide coverage. And we have to receive that application from you at least the month before your last day of employment, so that due to your impending retirement, we can allow you to enroll in the Access Plan so that you do have it in the month in which your employment ends, and thus we can certify your sick leave if you're taking an immediate annuity. So another important rule about sick leave conversion is that requirement that you do begin an immediate WRS annuity. So if you are eligible for retirement and you do have the state group health insurance, but you do not begin your immediate WRS pension, your immediate annuity, then this is another example when your sick leave will not allow to be certified for use to pay for retiree health insurance. And again, there could be an exception if you have 20 years of WRS service, but in general, if you are eligible to retire, even if you have the state group health insurance, you usually do want to begin an immediate annuity in order for us to be allowed to certify your sick leave. There are more details about the sick leave conversion program on ETF's website. They have a nice video series where they talk about the sick leave credit conversion program, and then they also have more detail in writing on their sick leave conversion credit program pamphlet that you can access online. Now, in this next section, we're talking about continuing other insurance plans after employment ends, as well as other access to campus, like IT access and the like. So first, we have state group life insurance. If you have state group life coverage for your spouse and dependents, you should know that that coverage ends the end of the month in which you do end your employment. And there is an option for converting their spouse or dependent coverage to individual whole life policies, and you can read more about that on our website. Just note that it will be more expensive to pay for converted policies than it had been when you were part of the employer term life coverage. The coverage on your own life with State Group Life may continue into retirement at normal employee group rates. If you're under age 65, those premiums will be deducted from your monthly annuity. ETF will just automatically continue that coverage forward, and they'll collect the premiums due each month from your annuity. But things change with your own State Group Life benefits in retirement at age 65 and older. So if you are turning age 65 as a retiree, the supplemental and additional units, if you've had them, fall away, and it's just your basic unit that carries forward. And the basic unit's death benefit is reduced compared to what it had been. It will be worth 75% of its previous value. And then as a retiree at age 66 or older, the value of your basic unit is worth half of its previous value. So maybe you'd earned $50,000 as your highest annual earnings ever, and thus your basic unit had been worth $50,000. At age 66 and over in retirement, the death benefit of that unit is now just $25,000, half of its previous value. However, after retiring and being age 65 or older, the basic unit has now become free to you. So you're no longer paying a monthly premium for it. And there is the possibility that you can convert the final value of your basic unit to continue to pay for retiree state health insurance premiums if you've since exhausted your sick leave value. So that's more to learn with ETF if that's something you want to explore. You may continue other insurance that you'd held as an employee of UW-Madison as well. Watch for a letter to arrive at your home address after the end of your employment that will let you know that you have 60 days from the end of certain supplemental insurance plans to submit paperwork and continue the coverage more directly between yourself and the insurance company. That would be true with the Delta dental plans, the vision insurance, the accidental death and dismemberment coverage, and the accident plan if you're under age 70. And there could be other insurance that you can convert to individually held policies. For example, the individual and family life insurance. You may have 31 days from the end of the life insurance to convert it to an individual whole life policy. So watch for notification about that conversion option after employment ends. When your employment ends, your IT service access will change. And there is a nice knowledge base document on the kb.wisc.edu page that will walk you through the steps to take when you're leaving the university. It could be different if you're retiring or retiring and receiving emeritus status than it would be for other kind of general end of employment. If you are retiring and you want to keep your wisc.edu email address active, speak to your local HR or payroll contact. It is something you can request and we can process through for you. The email that is the one that continues could be slightly different than what you've been previously sharing with others. So rather than, your first name, period, last name at your department.wisc.edu, it would be simpler than that. It would be your net ID at wisc.edu. Again, check in with your local HR contacts and they can arrange for that net ID at wisc.edu to continue. And for access to your pay records and your benefits records, you can log in to the Workday system, check in with your local HR or payroll contact if you have any questions about your Workday access. And you can also log in to ETF's My Benefits system to see your current benefits information, even as a state retiree. This section, we're talking about choosing when to retire and announcing your retirement. So what do you want to consider when you're thinking about what is the best date for you to retire, and then whom do you tell, and kind of the deadlines or the ideal timing for making these announcements to others. Here I have an example of some relatively simple and to the point resignation language. It could be as simple as telling your HR office that, I am retiring and my last day will be, or it's possible that you have earned leave that you intend to use kind of at the end of your employment to keep you in pay status. And it's when that leave is exhausted or you reach a certain date that you want to then be officially considered retired. So in that case, you might say, I am retiring. My last day on campus or in the shop will be, and then tell them that you'll use your other earned vacation or personal holiday hours, banked leave for so many work days so that your last day as an employee will be. And that is essentially a very simple way to share with your HR office that your employment will be ending. And if your employment is ending due to layoff, and so you're going to be retiring because of the layoff, then you might consider this language. Let them know that you understand your last day due to the layoff will be, and then let them know that you are eligible for an immediate WRS retirement benefit. And so tell them to please use retirement in lieu of layoff, which essentially means retirement due to layoff, rather than just a plain layoff note, as the reason code for the end of your employment, so that your health insurance can be processed correctly. And if you are being laid off, you will also have additional kind of notices from my office, the benefits office, letting you know what those special health insurance processes can be for someone who's being laid off and retiring due to that. So if you do have earned but unused vacation and banked leave, also called ALRA, you can use them in most cases to extend your employment beyond your last day performing work. So you might stop working in January, but have enough leave to carry you forward on our payroll, still our employee, into April, for example. This is not something that can generally be used if you are being laid off. But if it is your instigation of the end of your employment, then you might decide to extend your employment using your earned leave and thus remain our employee on our employee benefits even longer than you might have otherwise. Another option for your earned but unused leave balances is to have them paid out to you. Um, and so the payout to you would be as taxable income, but it will not be Wisconsin retirement system income. So it doesn't, for example, inflate your final year of employment as one of your highest ever, if it wasn't already going to be one of your highest ever. This lump sum payout is not considered in the highest income for WRS income. But it would be paid out to you as taxable income. And if you didn't want to immediately pay all the taxes on this lump sum, then you might have already prearranged to open one of the supplemental retirement accounts, the 403B with the Universities of Wisconsin or the 457B with Wisconsin Deferred Compensation, and then divert some or all of that payout into one or the either or both of these supplemental retirement plans. Thereby, if you do that pre-tax, avoiding the initial income tax due and just waiting to pay the taxes only in the future when you decide to take the money out of the accounts in retirement. As we begin to think about dates for your retirement, I do want to point out that the end of employment date, if you are a 9-month academic year employee, may have more structure to it than other employees who work year round. So for example, if you are not expected to return the next semester because of your retirement, and you won't have any income earning employment after the end of the semester. So for example, if you're ending your service to the university after the spring semester and you don't expect to work into the summer with summer session or service, then generally your last day of employment would be the last day of the contract, the last day of that semester. So for this most recent year, the end of the spring semester was May 18th, and so people could be employed retired as of May 19th. Or coming up here for me soon, the end of the fall semester will be December 31st. And so 9-month academic year employees might be retired as of January 1st. Or if they're ending the end of the spring semester of this coming year, then the last day is May 17th, and they could be retired as of May 18th. Another option for 9-month academic year employees that is relatively new is if you're working through the spring semester and you provide early notice to your HR office at the UW not later than May 1st that you want to continue to be an employee on unpaid leave through the summer, then that can be granted. And so, for example, as of this last semester, the spring semester of 2025, its last active paid date was May 18th, and somebody who had provided notice to their HR before May 1st could have gone on to unpaid summer leave of absence until the end of the kind of the summer time, which was for this last year, August 17th. And during that while, they're not earning any UW income, they're not receiving their WRS pension, but they're still an employee. And if they had been enrolled in employee benefits, those are still continuing for them, and they would have prepaid for those benefits already. And then they can become an immediate WRS annuitant as of the day after they're removed from the leave of absence. So in this example, August 18th could be their start date of their WRS annuity, or it could be September 1st, which is still within 30 days of the end of their employment, since the end of their employment was August 17th. So this is an option for some, but again, during that leave, they're not receiving any income from the UW nor from their pension. So I would say most people choose to elect option 1 instead, so they can begin to draw the pension more immediately. Let's talk about the pension, and then we'll dive again further into possible best dates to consider when someone's retiring. But here we'll talk about the Wisconsin retirement system and what it is, who's eligible for the pensions, and how much you'll make in retirement, which will also be affected by the date that you choose. There may be multiple sources of income in retirement upon which you'll draw, but today I'm focusing for our sake, on the Wisconsin retirement system, so the pension, the annuity program. And this Wisconsin retirement system is a pension or retirement program that all of us who are state employees and who meet qualifications will participate in. We must participate in the Wisconsin retirement system if we're eligible for it, per Wisconsin state statutes. And what this means, practically speaking, is that a deduction is automatically withheld from your paychecks pre-tax, and that money that is being withheld is going into the Wisconsin retirement system for investment. And there's also an employer match that is going in on the employee's behalf that is also being invested in the Wisconsin retirement system. And you can see those deductions and contributions on your payslips if you're looking in Workday at your payslips. You'll also see that the employer amount being contributed is slightly higher than your own, and that is in part because of employer fees. We at the UW have to pay certain fees to keep all well with the Wisconsin retirement system. So we're submitting slightly more than you are into the WRS. And then this money is being invested by SWIB, the State of Wisconsin Investment Board. And you can reach out to SWIB if you'd like to take a look at the investments that they're currently making. You can talk to them directly by calling their member services line. But you can and should track how the investments that they've chosen are affecting your own account by reviewing your annual statement of benefits every spring. If you find that you're pleased with how SWIB is investing your money and how it's earning, you can make additional contributions into the Wisconsin retirement system. And you can do so either via direct bank transfer between you and employee trust funds, or you can write and mail to them a personal check for deposit into your account, or you can set up a payroll deduction to come out directly from your UW-Madison income, and it would go automatically then electronically into your WRS account. If you choose to send these additional contributions, note that there is no employer match. It's just your own money going into the account, and that you will be taxed on these contributions. They're going to be part of your taxable income for the year. The WRS money is invested into trust funds. By default, 100% of your contributions and the employer match are being invested in what is called the core fund. This is a highly diversified account that applies a 5-year smoothing mechanism before applying annual effective rates to each of our accounts. More on that on the next slide. The other optional trust fund is the variable fund. And if you choose to enroll into the variable fund, which you do by submitting a form to ETF, then 50% of your money and the employer's match is still invested in the core fund, but the other 50% is invested in variable. And the effective rates of the variable are, no surprise, more varied year by year than are the core. So let's move to the next slide for more details. Here we see some recent history of the Wisconsin retirement system investments. And if we're looking at the left-hand side of the slide, we first see the core trust fund. So the most recently fully completed year, according to today's recording date, was 2024. The rate of return on investments for the year of 2024 core was 8.55%, a great gain. And the effective rate that was applied to each of our accounts was a gain of 7.5. So it wasn't the full 8.55, and that's because of the 5-year smoothing. The 5-year smoothing looks at the most recently completed year and the 4 years immediately before it. And in a way, they use an average of those 5 years that creates the effective rate that then changes the dollar values in each of our accounts. And that means when 1 year is higher than the previous 4, we may not feel that gain, at least not immediately, in our own accounts. But what it also does is protect us in years where there had been losses or very low earnings. It allows the smoothing mechanism to still provide us with a decent earning, an effective rate in our own accounts. So if you look back at 2022 and at 2018 and at 2015, you see that those were years of loss for the core trust fund investments. And yet the effective rate for each of our accounts, if we were employees all of those years, were still positive gains because of the 5-year smoothing. So that's what the core trust fund does. On the other hand, the variable trust fund is much more variable because the total rate of return on the variable year investments directly is applied and creates the effective rates for that year's gain or loss. So 2024, again, the most fully completed year as of the date of this recording, for variable was a gain of 18.7%. And that was rounded slightly. They always want whole numbers for the effective rates. That was rounded up to be a 20% gain for that part of employees' investment accounts. So if you had been both in the core and the variable trust fund all of 2024, part of your account earned 7.5%, and then the other part of your account earned 20%. The year before, 2023, part of the accounts earned 9.1%, and the other part of the accounts earned 22%. And then the year right before that, 2022, the core trust fund had still earned 6.5%, even though the fund's investments actually lost 12.92, while the variable trust fund actual investments lost 17.82%, and that was rounded slightly to mean a loss of 18% to the variable trust fund accounts for people who had been participating all of that year. So the core trust fund has its smoothing. The variable trust fund does not have smoothing. It has high highs or low lows, whatever is appropriate for the actual investments that year. And so it is up to you whether you've been part of the core and only ever the core and always had the 5-year smoothing over all of the investments, or whether you've been part of the core and the variable, knowing that the investments are different and how they're moved into your accounts at the end of a year are different. The variable trust fund is a riskier investment, but it can also provide higher gains in years that have gone well. If you have been part of the variable fund, then you may participate in the variable for as long as you'd like, either one full year and you're out, or for as long as you live, or somewhere in between, if you decide that you're in the variable and you no longer want to be part of the variable. There is a cancellation form that you can complete and send to ETF. You would still complete that year in which you sent the cancellation form to them. You'd have to complete that year, but then you could be out as of the next January 1st. If you do that, though, if you're part of the variable and then you remove yourself, cancel the variable, you can never go back to the variable again. It's just a one-time opportunity, be in it for as long as you like, and if you choose to remove yourself from the variable, you're out for the rest of your life and only in the core after that. Now, these accounts are being invested, earning money, and ultimately they should provide you with a retirement benefit. So if you are a full career WRS employee, which we usually say means 25 to 30 years of employment, what you can expect for your WRS retirement benefit could be between 60 to 85% of your pre-retirement gross earnings. And that's when you combine what you'll receive from the Wisconsin retirement system with what you might expect from the federal Social Security. So you could expect after a full career and then receiving both state and federal pensions to have between 60 to 85% income replacement. Now, not all of us will work a full career under the Wisconsin retirement system, and so you might expect a lower income replacement. Others might be working two careers worth within the state, and in that case, you might expect a higher income replacement. Occasionally, not often, but rarely, still, it does happen. Some people, when they retire, receive more in retirement than they did when they were actively employed. That's, again, somewhat unusual, but it can happen, especially if you've had a very long career of 40 years or 50 years with a state. So to be eligible for your Wisconsin retirement system annuity, you must be vested in the Wisconsin retirement system, which again, for most of us means we've earned at least 5 years of creditable service. And then you need to be old enough to start your annuity. For most of us, that means we have to be at least age 55, though if you are a UW police officer, you could be as young as age 50. And then you have to have requested from employee trust funds your annuity application, received it, completed it, and provided it back to them in order to become an annuitant. And you have to have ended your WRS employment and served a valid good faith termination, serving at least if not longer, than 75 days of a break in employment with the Wisconsin retirement system in order to have received and able to keep your pension. You can begin to run unofficial estimates of what your future pension may be at any time using the calculator on Employee Trust Fund's websites. It is, again, an unofficial calculation because you're the one inputting the information, but assuming you input it smoothly, especially if you're using your annual statement as a reference when you're going in and adding what might be your 3 highest years of income and how many years of service you had before versus after the year 2000, that will help create a quite accurate estimate of what your future retirement benefits may be. And you can begin to request official estimates from employee trust funds as young as, for most of us, age 54. So if you could retire in the coming year, for example, if you are 54 today and you'll be vested by the time you turn 55, you could request from employee trust funds an estimate application using the date of your 55th birthday as your possible future retirement date. So you can request that from them. They will receive your request and run numbers and then mail back to you an estimate application packet with those proposed future pension numbers. And in most cases, you make your request for the estimate online on ETF's website. There might also be a paper form that you could request to be mailed to you if online doesn't work for you. And once ETF crunches the numbers and mails the packet back to you, or if you've run your own estimate in the calculator and now it's producing numbers for you, what you'll see is that there were 2 types of annuity calculations that they will have run through. And the one that will pay you the best, the highest monthly pension, is the one they're actually printing on the calculator estimate or the official estimate application for you. So one of the methods is the formula method, where they've reviewed your years of creditable service, usually the more years of service, the better, your final average earnings, which are currently based on your 3 highest years of WRS income. And they look at formula factors such as what type of employee are you, when did you earn your service. They also look at any age reduction that needs to be factored in. So if you are younger than full retirement age, which they currently consider age 65, they take that into consideration since they're calculating a lifetime benefit for you. And they would also consider any variable adjustment that might needs to be considered. If you've been part of the variable and your account totals have earned more because of your variable participation, that will mean a higher annuity for you compared to if you'd never been part of the variable. On the other hand, if you have been part of the variable and it underperformed compared to the core, so that your account would have been higher if you'd never been in the variable at all, then that will mean a reduction in the possible annuity they can provide to you. So they'll look at all of those pieces for the formula calculation, and then they'll compare that to what they run under the money purchase calculation, which is when they look at your actual account balance, which may be higher or lower based on variable participation, and your age at the time of this proposed retirement. And one of those versions of the calculation will be higher than the other. So that will be what they officially print for you, and that you would be offered if you were to be retiring. So back to choosing a best date for retiring, you want to consider your type of employment so that when you think about what month you retire in or the day of the month, your type of employment could affect your pension itself or the benefits that you receive in retirement. So if you're university staff, your earnings and service are being earned on the calendar year, so January 1st through December 31st. And if what this year was, for example, going to be one of your highest paid ever, then you might want to complete the calendar year and retire perhaps in early January in order to have one of your 3 highest years have been this most recent calendar year. You might also consider the drop in of personal holiday hours, which are now based on the fiscal year. You'll receive a full drop in of personal holiday hours every July 1st. And then even if your last day was July 1st and you're retired as of July 2nd, you still will have earned and be paid for that full drop in of personal holiday hours. If you are faculty, academic staff, or a limited appointee, which we in short just call FASTly here within OHR, then you'd think about your earnings and service being based on the fiscal year. So July 1st from one year through June 30th of another year. And if this most recent fiscal year would be one of your highest paid ever, then perhaps you want to work through June and retire in no sooner than July of the next fiscal year, so that this most recent fiscal year of yours is counted as one of your highest ever. And also your personal holiday hours are dropped in July 1st of every year if you are a 12-month, full year academic staff or faculty employee. And so again, choosing July 1st as the last day of employment and July 2nd as your retirement date would then allow you to still receive those personal holiday hours and their value paid out to you. Another thing you might consider about your best date is the insurance that you have now, and is it the insurance that you want to continue into retirement? So for example, State Group Health Insurance. If you are not currently enrolled in State Group Health Insurance, take a look at your sick leave hours that you have been earning and saving as an employee, and think about how valuable those hours will be in retirement to help pay for continuing retiree health insurance. If you decide they are valuable enough, then you may want to enroll into State Group Health before you retire so that then we can certify your sick leave. Or if it will be your spouse who is going to pick up the family's health insurance when your employment ends, think about what the timing of your spouse's change will look like if they have to submit new forms to pick up the coverage after your coverage has ended. You might also think about supplemental insurance. If you want supplemental dental or vision as a retiree, but you don't currently have it as an active employee, think about whether there are any upcoming enrollment opportunities, like the annual enrollment period, or if it's life insurance, think about if you were to enroll under evidence of insurability, how much longer will you work? And then if your employment ended, would you be allowed to convert that life insurance policy to a whole life policy? Those are questions that you could ask my office about if you don't currently have the coverage, but you're thinking about whether you would want them in retirement. You might want to take time to actively participate in these programs first for a time before you before you retire, so that you can continue or convert them as a retiree. And then also important is to consider the type of annuity calculation that ETF believes will be your highest calculation in retirement, because the strategies for receiving the highest formula benefit is different than the strategy for receiving the highest money purchase benefit. So with the formula method, they're looking at your final average earnings based currently on your 3 highest years ever. So, finishing up a full year, whether that's a calendar year or a fiscal year, could be of importance to you under the formula method, or earning the most possible WRS service that you can before you retire could be important to you. Even just the age reduction itself may be important to you under the formula method. While under the money purchase method, they look at your age and they look at your account balance, the actual money that is in the account for considering what your annuity will be in retirement. And the higher you can make your age at the time of retirement, or the higher you can build your account balance before you retire, the essentially higher your annuity would be. Here's a note about money purchase calculations. So the money purchase benefit is required if you retire mid-year. It is required by law to imagine that your account would have earned 5% if you had been able to work all through the year and the money was invested all year long. So if you have to leave before the calendar year is over, the system is required to add a prorated percentage of 5% to your account balance before they finalize what your annuity will be. So for example, if you retired in February, then they will add to your account balance, whatever is in your account, they will add another 0.417%. Or if you retired and started your pension in September, they would add 3.333 growth to the account balance that was sitting in the Wisconsin retirement system before they finalize your annuity. If you instead retired in January, then whatever kind of happened in that year is what the previous year is what they will apply to your money purchase account balance. So whatever happened that previous calendar year in the investments is what will be added to your account. If you've been part of the variable trust fund and now you are retiring, your variable trust fund participation will affect both the formula and the money purchase benefits, but in different ways. If your benefit for retirement is higher under the formula method calculation, then the core and variable portions of your monthly annuity will normally not be proportional to the amounts in your core and variable accounts. Most of your retirement pension payment will be based on your core monies and less will be based on the variable portions. And the part of the pension that's based in core has a guarantee that it will never drop below what they initially confirm is the value of your core pension. While the amount of your pension that is continued to be based in variable investments will rise and fall with how the variable continue to performs in the market year by year. Under the money purchase method, your benefit, if it's higher in that way, the core and the variable portions of your annuity are in direct proportion to the amount of money that you have in your core versus your variable accounts. And again, that just is something to keep in mind, noting that, do you have more money in the account because of your variable participation or less money overall in the account because of your variable participation? It's something to note. Now, the formula method, again, going back to how they calculate the formula method, weighs heavily on your years of creditable service. That is a very important part of the formula method calculation. Usually, the more creditable service you can earn before you retire, the higher your annuity may be. And we in the WRS earn creditable service based on the hours for which we have been paid during our year. So if you are university staff in what they call the general category of the Wisconsin retirement system, your service is earned on the calendar year. So from January 1st through December 31st, if you receive pay for at least 1,904 hours of WRS service, then you have earned a full year of creditable service. And a full-time employee will usually be paid for 2,080 hours during the calendar year. So you could even have gone unpaid slightly for a portion of the year and still receive a full year of creditable service. Now, faculty, academic staff, and limited appointees, who are considered the teacher category of the Wisconsin retirement system, they earn service on the fiscal year. So from July 1st of one year through June 30th of the next, if you are FASTLY and you're receiving pay of at least 1,220 hours for at least 1,020 hours of employment, then you have earned your year of creditable service. And that does account for those who are just 9-month academic year employees only who don't work over the summer. If you're working a full-time academic year appointment, you should expect to be paid for at least 1,320 hours over that 9 months. And so you still earn your year of creditable service. Anything more that you earn above these minimum number of hours is extra pay for you, but it is not adding more service to that year. Just as soon as you hit your year of creditable service, then the creditable service count stops until the year resets, whether that's January 1st for you or whether that's July 1st for you. So creditable service can affect you not just with the formula method, meaning that the more years of creditable service you have, the higher your formula method calculation may be. But it also affects you in that you need usually at least 5 years of creditable service before you can be considered vested and thus eligible for a future retirement benefit. And then sometimes you hear people talk about the value of having 20 years or even 30 years of service. And they're likely talking about these two pieces. If you have at least 20 years of creditable service and your employment has to end, then your sick leave may still be preserved, even if you don't begin an immediate annuity. So that's kind of the special piece about having 20 years of service, is that you don't have to begin an immediate annuity to still have your sick leave preserved for you. And then if you have 30 years of creditable service and you are at least age 57, then under the formula method calculation, ETF will not impose an age reduction upon you. So it's like they pretend that you're already age 65, even though you're only 57 or 58 or 59 or 60. That 30 years allows them to imagine that you're already 65, you don't need an age reduction under the formula method. You may want to talk to employee trust funds about purchasing back other creditable service. So if you do have any previous military service, or if you have forfeited WRS service that you'd earned once upon a time and you forfeited it when you took the money out of the Wisconsin Retirement System account, and now you've since been rehired and you're working again, but you'd forfeited that previous service, you might be able to buy it back. Or if you have other governmental service that you earned with the federal government or in another state outside of Wisconsin, talk to ETF about the price you would pay to purchase that other creditable service and move it into the Wisconsin retirement system. And they will be able to run some numbers for you to show you not only how much you would have to pay to buy that service back, but also how much it might affect your future retirement benefits. And then you can consider whether it's worth it to you to actually spend the money now to buy that service, knowing that it could eventually be repaid back to you if you live long enough and receive the higher retirement benefit to make it back. Now, with the money purchase calculation, an important part of this calculation is both the account balance itself. The higher your account may be, then the higher the annuity would be under this calculation. And it's also going to be based on your age at the time of retirement. And in this case, the 30 years doesn't mean that they pretend you're 65. It's not taken into consideration. They look at your actual age that you will be in retirement. Also important, though, with this calculation is the interest that they may add to your account, which then affects your actual WRS account balance. And the higher, the better for your finalized money purchase calculation. And again, I reference back to this proration of the imaginary 5% gain that an account might earn over the year that they would then add to your money purchase balance. If that is the highest method by which they calculate your annuity, then the month in which you retire is an important decision, because the later in the year you retire, the higher the extra proration amount they will add to your account. And consider whether you're going to retire in late December versus early January, because if you leave in late December and you're a money purchase calculation, they will add to the balance of your account another 4.583%, while if you instead begin your retirement benefit in January, they will add to your account or remove from your account whatever is actually true for the previous year's investments, whether they are gains or losses. The actual gains or losses will be applied to your account before they finalize your annuity. Now, coming up, we'll talk about the different annuity payment design options. And if you haven't yet watched the Wisconsin Retirement System Annuity Options video that ETF offers on their website, I would encourage you to do so in the future. They take, with just 6 minutes, kind of what I will describe over the next many more minutes, very nice and concise, and they offer visuals as well. So if you're trying to describe these annuity payments to someone else, having them watch this video with you is a great method. It was a preview of what I'm about to describe with the annuity designs. I want to point out that some of the designs may offer a beneficiary benefit, which is a death benefit, if there's allowed to be one, that would be paid out to your beneficiary or beneficiaries as a lump sum, or maybe just for a limited time. But there would be an end to the death benefit payment up to a beneficiary. And that's different than those options that offer you a choice of choosing a named survivor. Because if you choose an option that has a named survivor and then you pass away, but your named survivor still lives, then your named survivor begins to receive a lifetime benefit every month for the rest of their life, ending only upon their death. So that's a difference between those that offer a beneficiary benefit versus a benefit for your named survivor. So in the upcoming estimates that I will show you, I have run them based on Jane here as our retiree. So Jane is retiring at age 59. Her spouse is also age 59, and she's had more than 20 years of creditable service, and her 3 highest years were each exactly $50,000. So that's unlikely to be the same as you. You'll want to, if you're using the calculator, run your own numbers, but that's what I popped into the calculator to create this next slide. So here are the results of Jane's details that I entered into the calculator. Here's what came up for Jane. What you'll see is that there are 3 life annuity options at the top of the screen that are based on Jane and her life expectancy. And then there are 4 further below that are called joint and survivor annuity options. These are options that included Jane's spouse and Jane's spouse's life expectancy when they were coming up with the numbers that they could offer to them as a couple. And then kind of in the middle of the slide, you see that there's a regular retirement benefit column, kind of a constant payment that they can rely upon every month for their lifetimes, versus the accelerated payments, where while Jane is still younger and not yet 62, Jane would receive a higher payment from the annuity. And then as soon as she turns 62, the annuity is going to drop. And the purpose of that drop is to imagine what Social Security benefit Jane might begin to draw when she turns 62. That Social Security benefit should make up the difference in ETF's mind of what she had been receiving before as the accelerated payment versus what now she's receiving as the lower payment. Of course, Jane may or may not truly want to begin Social Security at age 62, but if she chose the accelerated payment option, she will have that reduction in state pension at age 62, whether or not she starts the federal pension as well. So for our purposes, as I talk through these options, I'm going to use the regular column, but certainly reach out to my office if you have questions about the accelerated payments. So starting from the top on the regular column, first we see the annuitant's life only option. So that would be paid to Jane $1,464 every month for her entire life. But when she passes away, the money ends. The account closes up, and anything that she had contributed during her life and that the employer had matched, it just remains in the Wisconsin retirement system to help maintain the system as a whole. The second option is for $1,459 a month, and it offers a 60 payment guarantee. So in this case, Jane would receive that $1,459 every month for her entire life. But if Jane dies soon after retirement, before she has received a full 60 payments, and that's a 5-year window following her retirement, then if she, for example, dies after just 12 payments received after a year of retirement, then ETF will see that the minimum of 60 payments guaranteed had not been met. And so rather than closing the account right away, ETF will look to her beneficiary form, and they will pay out the remaining installments to her beneficiaries and will close the account once the 60 payments have truly been issued out. So Jane might have received the first 12, the beneficiaries receive the remaining, and then the account is closed and no more money comes out of the account after that. Or Jane could choose the 180 payment guarantee, which is a 15-year window following her retirement. In that case, she'd receive 1,420 dollars every month for the rest of her life. But in the event that she dies before she's received a full 15 years worth of payments, maybe she's received just 100 payments. That means there's 80 more to go, but she has passed away. Then ETF looks to her beneficiary form, and they will make those remaining 80 installments. They couldn't pay Jane. They'll make the remaining to her beneficiaries, and only then will the account close. But of course, in these options, if Jane lives a long life in retirement, she continues to receive the benefit that she chose every month for her lifetime. It's just that if she lives beyond the minimum payment guarantee, that then upon her death, there is no more money to pay out to her beneficiaries. Next, we can take a look at the joint and survivor annuity options. So these are the versions that would pay out to Jane's spouse, if she chose her spouse as her named survivor, in the event that Jane dies before her spouse. So the first option is 75% continue to name survivor. If Jane chooses this option, she will receive $1,345 every month for her entire life. But if she dies before her spouse, then The spouse would begin to receive 75% of what had been paid to Jane every month, so a smaller amount, but still a payment every month for the rest of that spouse's life. And the account would close only upon both Jane's death and the spouse's death. If Jane chooses the second option, 100% continue to name survivor, then Jane would receive $1,310 every month for her lifetime. If she dies, but her named survivor, in this case her spouse, survives her, then the spouse begins to receive the full $1,310 every month for the rest of their life. And the account only closes once both Jane and her spouse has died. The third option is the highest of these latter four joint and survivor options, but it's the one that could affect Jane negatively if it's her spouse who dies before she does. So if Jane chooses this reduction by 25% on the death of the annuitant or the named survivor, then Jane would initially begin to receive $1,383, and she would receive that each month that both she and her named survivor are living. But if Jane's named survivor dies before she does, suddenly Jane will see a reduction of the money she's been receiving. She'll receive only 3/4 of that $1,383, and she'll receive that lower amount for the rest of her life. Or again, if it's Jane who dies before the named survivor, then the named survivor begins to receive the money every month, but they receive only 3/4 of what had previously been coming in when the both of them had been alive. And then the last option is 100% of a continuation to the named survivor with a 180 payment guarantee. So in this case, if Jane chooses this, she would receive $1,308 every month for her lifetime. If she dies and her named survivor yet lives, then the named survivor will begin to receive the $1,308 every month for their life. But if both Jane and the named survivor have passed away, and together they hadn't yet received a full 15 years worth of payments. Again, that's what the 180 payments would allow. So perhaps Jane dies after 10 payments, so 10 months, and then her named survivor receives the payments for their own 10 months and they also die. So only 20 payments in total have been paid out. That would leave 160 payments that haven't yet gone out, but they were guaranteed to go out. So ETF will look to the beneficiary form on file, and ETF will make the remaining installments to the beneficiaries, and only then would the account close. And of course, if Jane or the named survivor live beyond the 15-year window, then they continue to receive the payments for their lifetimes, and the benefit only ends when both Jane and the named survivor have both passed away. So those were many different options, and not all of us will see all 14 options. Some of us, if we're retiring after age 62, we won't see the accelerated column, we'll only see the regular column. And if we do not have an eligible named survivor that we've asked ETF to run numbers for, then we won't even see those lower 4 designs. We'll only see the first 3 based on you as the annuitant's life expectancy. So you can review these options and learn more about them by watching ETF's video and attending potentially a webinar offered by ETF that they routinely offer called Annuity Options. And then you can certainly also look at ETF's brochure called Choosing an Annuity Option that gives you in writing the details about these programs. All right, so now let's talk about living in retirement. We're talking about maintaining good faith terminations. We're talking about how much your pension could change after you retire. And we'll talk about working while still receiving your pension payments and what that looks like. All right, so this information comes straight from ETF's resource called Information for Rehired Annuitants that describes things to watch for if you're considering coming back to employment following your start of your pension. You have to maintain a good faith termination, and a valid good faith termination means that you have ended your services to your employer. You do not expect or are not due any additional wages, that both you and the employer have completed the employer policies for a voluntary termination, including filing the letter of resignation, or if you're being laid off, that you have submitted your letter saying that you're resigning or you're retiring due to the layoff. And then as of the termination date, the employer has no rights to any future services by you, which means that you have ended the employee-employer relationship and there is no expectation of any future work that you will perform for the employer. And this includes any work that you might be required to provide through an emeritus program. So being granted emeritus as a recognition of your previous good work is honorary. That's a title. But if you're actually being granted emeritus so that you will perform services specifically for the UW, for example, then that would not be a good faith termination because you would be retiring and yet still expected to perform work. So good faith termination means ending that employee-employer relationship completely. And it is worth noting that within this brochure of ETFs, they also point out that contracts or agreements entered into during the minimum break in service period, which is a 75-day window between when your employment ended and when it's possible to come back as an employee with a state or with a local WRS employer. Contracts or agreements entered into during that 75-day break in service bring into question whether the termination was done in good faith. It could seem to ETF that you ended employment, and then if you immediately, during the 75-day window after that, agreed to come back to work for the UW or another employer, after that, that it makes a gray area of whether that was a good faith termination. So it's recommended that you do not enter into agreements for future employment during the 75-day break of employment. If ETF were to consider or wonder whether there was an error or in the good faith termination situation, then they can perform an investigation. And the burden of demonstrating that the termination was done in good faith falls on the employer and employee. And if ETF determines that the termination was not in good faith, then any annuity or health benefits that have been received in the meantime could be discontinued, and ETF can collect back all the payments that they deemed had been made in error. But we will assume, of course, that you do make a valid, good faith termination between the UW and yourself. And so after your employment has ended and you begin to receive the pension from employee trust funds, you do have a short window of time to change how you receive your annuity. So if you chose one type of annuity design and then you wished you'd chosen a different version, you have 60 days from the date you first begin to receive your annuity from ETF to change your mind and submit updated paperwork to ETF to make a change. And this can happen if initially you choose the, let's say, 75% continue to name survivor, and then you realize that, you know what, I can live off of the lower amount if I'd chosen the 100%, and I would like to leave my named survivor 100% if I were to pass away. That's something that you could make a change to as long as you do so quickly within the first 60 days of receiving your annuity. Just reach out to ETF. Another change that might occur after you've retired is when the final calculation comes through for what your annuity payment should be. So initially, you have your estimate application and you make your annuity design change or your choice based on the estimate. And ETF is very good at what they do. So if you are retiring near to the date that you'd used for the estimate application, then things should be very close when it's finalized to what ETF had been estimating. But if you had significantly changed the date of when you retired, maybe you left 2 months earlier than what they had used for the estimate, or maybe you worked 2 months longer than what they had used for the estimate, then you might expect a different calculation once ETF finally comes back to you, maybe 4 months after you've retired with the final calculation. And they look at the real details of how your employment ended and the actual, highest years of earnings and how much service you really did earn and how old you were when you really did end employment. All of that could affect the final calculation. And if they come back to you and they'd been underpaying you, then they will make you whole. They'll pay you the amount that you're due in a lump sum, and then they'll start to pay you the higher amount going forward. But if they come back to you and they recognize that they'd been overpaying you, they will ask you to repay them for the amount that had been paid to you in error, and then they'll begin to pay you the more correct lower amount going forward. There are not any automatic cost of living adjustments to the Wisconsin pension. Instead, what can affect your annuity from one year to the next is the investments in the trust funds. How the trust funds continue to perform in the market will affect you as a retiree. It will affect whether or not you can receive a raise from one year to the next. So every year, depending upon how the trust funds performed, you as the retiree will be shown a possible change to what your annuity will be for the next year. And that will affect from May through April of an annuity each year. So it's just something to watch for that ETF will send you a letter about every spring. And I mentioned it a bit before, but how your annuity is built, whether it's built on core investments or it's also relying on variable investments, that can affect how your annuity might change in future years. So the amount of your annuity that's based on core participation, once it's finalized, will never drop lower than its finalized amount. So this is called the core floor, and the amount of annuity that's based in core money will have a guarantee upon it. It will never drop below where it started. It can go up if funds perform well. It can go back down to where it started, but it could never go below where it began. On the other hand, if part of your annuity is based on variable funds, then there is no guarantee on the variable portion of your annuity. And that can mean that poor variable investment performance in the future could reduce that part of your annuity to an amount even below where you started when you first retired. So again, variable performance can vary wildly from one year to the next. So in one year, it might increase greatly. And so your raise for that year might be a very good one. And then the year after that, it could perform very poorly. And so that could take you down to where you started as a retiree or even mean a lower benefit than you'd started off with as a retiree. And so that's why some people, when they retire, decide to remove their money from the variable, while others are comfortable remaining in the variable. They might have other means of income that they can rely upon in those bad years, if there are any, when the variable performs poorly. And then they have faith that in the long run, the variable will perform well, and they feel comfortable staying in it. So each of us will have to make that decision for ourselves, whether we want to remain in both the core and the variable, if we have been part of both. And here's just a peek at, as of today in 2025, the most recent history of annuity adjustments for retirees. You'll see that following the year 2024, annuity adjustment for the core trust fund was a raise of 2.3% for the next year, from May through April, May 2025 through April of 2026. And for the adjustment in the variable trust fund for retirees who still have money in the variable, they had a gain of 15%. A few years before that, though, in 2022, annuitants had a much smaller gain to their baseline annuity. They had a gain of 1.6% for the core trust fund, while if they had been part of the variable trust fund still, that part of their annuity lost value. It lost 21%. Although then the very next year, the core gained 3.6 and the variable gained 15% for their annuity adjustment. So they did recover from that, but for that year following 2022, they may have received less than they'd even started out with as an annuitant. Other things that could affect your WRS account is divorce. It is possible that a court could award up to 50% of your WRS value, your account value, to a former spouse. And if you were already receiving your annuity at the time that the court awarded the percentage, then the annuity itself is divided between you and your former spouse. You'd continue to receive the percentage that you were allowed to keep from the court, and then your former spouse would receive the amount that they were awarded as their percentage. If you hadn't yet begun to receive your annuity, then it's the actual account dollars and the service that was assigned to those dollars in the account that would be separated. So you would own the portion of your account that you were allowed to keep, and your former spouse, would be awarded the account that they were granted by the court. And the annuity that you receive is still considered taxable income for federal and Wisconsin state income taxes. However, the annuity that you receive is not subject to Social Security nor Medicare taxes. So I like to give the example that $1,000 of a monthly annuity is still more take-home pay um, at the end of the day than $1,000 that's paid to you as an employee. Because as an employee, not only do you have to pay federal and state income taxes, you also have to pay Social Security and Medicare tax on that $1,000. And so your annuity itself has fewer taxes withheld, more take-home pay at the end of the day. An ETF will send you a tax document every year, a 1099-R, to file for your taxes. And you can read more about tax liability on the ETF publication that I list here on the screen. It's called 4125. Now, if you are considering employment in retirement, if your new employers are not part of the Wisconsin retirement system, then your Wisconsin retirement system annuity is not affected at all by your new employment. You might be working full-time at some other employer and still collecting your full WRS annuity every month. The two don't interact with each other in a negative way at all. However, if your new employment is back with a Wisconsin retirement system employer, then you will be asked by your new HR department to complete your portion of a rehired annuitant form within 5 days of your rehire. And you'll be reviewed, the form and the expectation of your job will be reviewed to see whether or not you can continue to receive your annuity and your retiree insurance while you're working. Or if you're going to be working so long or so many hours that once you're back at work, your annuity and your retiree insurance have to be suspended. And so the key is to consider whether or not your job under the, with your WRS employer is going to be short term or longer term. Short term would be less than 1 year. Longer term would be 1 year or more. And then if it's going to be 1 year or more, how many hours over the course of a year are you going to be expected to work? If it is very few, fewer than 880 hours, for example, then you could expect to both continue to receive your pension and now be receiving your part-time, short-term employment income. But if your job is going to be a year or longer and you're going to be expected to work more than 880 hours if you're faculty or academic staff, or more than 1,200 hours if you're university staff, then your annuity will be suspended temporarily while you're working. You'll be unenrolled from the retiree insurance, but as an employee, you'll be part of the Wisconsin retirement system again, and you can enroll in employee insurance. And then you'd have to re-retire when that new job ended to wake up your previously suspended annuity and re-retire in retirement benefits. And you might be eligible for another payout from your new WRS account that you had created. So here's a screenshot from the current rehired annuitant form. The top portion of the form is for your employer to complete. So your HR office should have completed this before they give you the form. And if it's not completed, let them know that you will complete your section as soon as they do theirs. So they complete the top portion, and then you complete the lower employee portion. And because you're watching this video now, I would assume that you are retiring after July of 2013, and so you'd be completing box 2 and noting, based on the information that your HR office entered above, you'd note whether or not you are expected to be allowed essentially to keep your pension while you work. And then you'll sign and date the form. If you do have to come back under the Wisconsin retirement system, you'll mark whether or not you're going to be re-enrolling in the health or the state group life or the income continuation disability insurance, or whether you're waiving all of them. And that's part of what you give back to your HR office. And here we've made it nearly to the end of our presentation. So we're wrapping up and talking about key takeaways and what to do next. So I do hope we've met our goals for today, but let's just review them. So we have hopefully identified the basic steps to retirement. You will, for example, have asked ETF for an estimate application. You will have chosen what your last day of employment will be, whether or not you're using earned leave to extend your time on payroll, and you will be making those announcements to your own HR office. And when it comes time to be nearer to the actual end of your employment, you'll send to employee trust funds the completed estimate application, maybe about 2 months before your end of employment. And then as far as strategies go for choosing a best retirement date, honestly, often just what you believe is the best date for you is the best date for you. But if you were looking for extra pieces to think about, you can again think about whether or not you have the benefits you need now so that they can continue with you into retirement. You can think about whether you are soon to finish up one of your highest years ever, and make sure then, if you are, if that's important to you, that you complete that year so that it's counted if you're a formula method benefit. And you might also, again, consider whether you've earned enough service to be where you are for your annuity that you would like. You can consider whether or not you're a formula or a money purchase benefit. And again, if you're money purchase, working later into the year, if you were considering retiring early in the year, instead, if you work a little bit longer, could mean a higher amount of money in your retirement account when they finalize your money purchase value. And then resources. I've mentioned many resources so far that are available to you, and I'm about to pull out a few more. So here we go. So if you are ready to take action on notifying folks about your retirement, then 2 or 3 things that you probably will need to do. Again, you'll need to talk to your own department or division HR so that they know that you're resigning because of your retirement. You'll also want to let employee trust funds know that you're retiring. And you do this by having already requested the estimate application, complete the form, and then you give it back to ETF. Again, ideally about 2 months before the end of your employment, if possible. And then if you are, or your covered spouse is, age 65 or older, then make sure that you're enrolling for Medicare Parts A and B to coordinate with the end of your employee health insurance and the start of your retiree health insurance. Here is a grid that I hope you find helpful about the paperwork that you might expect to complete for this process. So you're, again, requesting an official estimate from employee trust funds, and you do this maybe 6 months to a year before you intend to retire. Again, you are also welcome to begin to request these estimates years before you know you'll retire. As long as you could retire in the next year, you can ask for an estimate, so at least you look at it, you become familiar with offerings, and then if you don't retire that year, you just shred it and ask for a new one so that you always have a new version on hand for the year in which you retire. And then when you're ready to retire, you'll actually complete the estimate application and send it back to ETF. You'll also be writing your resignation letter or email to your own department, your supervisor, so that they know that you're leaving due to retirement. And you'll also be working with your department to submit all final leave reports so that we, for example, know exactly how much sick leave you have earned versus used so that my office can certify the value of your sick leave when you do retire. And the other paperwork that may be completed are the applications for Social Security, the federal pension. You can do that as young as age 62. And you will have to sign up for Medicare at age 65 or older if you are now retiring. So you don't need to do this if you're not drawing Social Security and you're still actively our employee, but if you're moving to the retiree health insurance, you must pick up both Medicare Parts A and B to coordinate with that retiree health. I list here various resources available through UW-Madison, our website, and also the Universities of Wisconsin and their website. And here we have employee trust funds and their various resources that I've mentioned earlier today, but just listing them all on one page for convenience. And lastly, the federal resources for Social Security, Medicare, Medicaid, and the enrollment for A and B if you're moving to retiree health and are 65 or older. And we have come to the end of this presentation. I hope it was useful for you. And should you have questions remaining in your mind, which I would be surprised if you do not, again, review the resources and reach out to my office. Our email address, benefits@ohr.wisc.edu, creates what we call a ticket. So we will track the emails that come in. We make sure that we address questions as best we can or provide resources if we're not the ones who can answer. And you can expect us to get back to you. So send us questions and we're happy to help. Thank you for hanging out with me for this nearly 2-hour presentation, and I look forward to working with you in the future. Take care, everyone. Have a good day.